Good evening. This is Jonathan Simkovitz, and you are listening to Global Markets Daily Brief for Friday, the 10th of April, 2026. The headline this week is that Treasury Secretary Scott Bessent and Federal Reserve Chair Jerome Powell summoned the chief executives of the largest American banks to Washington to discuss cyber risks from a new artificial intelligence model. That is the surface story. The deeper question, the one that actually matters for capital allocation, is this. When the Treasury and the Federal Reserve jointly escalate an emerging technology risk to the level of a private meeting with systemically important banks, what does that tell us about how policymakers are beginning to reprice the financial sector, the technology sector, and the relationship between the two? Because that is the real question on the table tonight. Let me walk you through what happened. Earlier this week, Secretary Bessent and Chair Powell convened the chief executives of Citigroup, Morgan Stanley, Bank of America, Wells Fargo, and Goldman Sachs at Treasury headquarters. The subject was a new model from Anthropic, internally referred to as Mythos, with capabilities in identifying and potentially exploiting software vulnerabilities across major operating systems and browsers. Anthropic, for its part, has restricted access through a program called Project Glasswing, working with a small number of technology and financial institutions to harden defenses before broader release. The initial market reaction was what you would expect. Bank stocks drifted lower on the headline, led by the names in the room. Cybersecurity equities caught a modest bid. The large language model ecosystem names saw a brief wobble on concerns about regulatory overhang, then stabilized. Credit spreads in financials widened by a small amount, nothing dramatic. Treasury yields were essentially unchanged. That is the first-order reaction. Let's step back. The consensus framing of this story as it is circulating through the financial press is that this is a cybersecurity event. A new tool exists. It is dangerous in the wrong hands. Regulators are being prudent. Banks will spend more on defense. Life continues. I think that framing is incomplete. What is actually happening here is that the United States Treasury and the Federal Reserve are for the first time in a visible way treating frontier artificial intelligence as a potential source of systemic financial risk. Not a productivity story, not an innovation story, a tail risk story. And when Treasury and the Fed begin coordinating on a tail risk, they are not doing it to inform the banks. The banks already knew. They are doing it to establish on the record that a conversation occurred. That is how policy groundwork gets laid. Consensus is pricing this as an isolated incident. I do not think it is isolated. Here is what I believe is priced in. Markets have priced in higher cybersecurity spending by banks. Markets have priced in a modest incremental compliance cost. Markets have priced in the continuation of the artificial intelligence capital expenditure cycle at roughly its current pace. Here is what I do not believe is priced in. Markets have not priced in the possibility that frontier model releases become subject to a new layer of pre-release consultation with financial regulators. Markets have not priced in the possibility that banks begin to demand indemnification or liability sharing from their technology vendors. And markets have not priced in the second-order effect, which is that the artificial intelligence theme at the margin starts to carry a small but persistent policy premium that it did not carry a month ago. My base case is that over the next 1 to 4 weeks, we see a quiet but meaningful shift in how the market treats the intersection of financials and frontier artificial intelligence. I expect bank management teams on first-quarter earnings calls beginning next week to be asked directly about cyber exposure and about their relationships with frontier model providers. I expect most will answer carefully in language that has clearly been reviewed by counsel. That language itself will be the signal. I expect Treasury to follow this meeting with guidance, probably informal at first, on how banks should evaluate third-party artificial intelligence risk. I expect the Federal Reserve's supervisory arm to begin including artificial intelligence-related cyber scenarios in its stress testing dialogue even before it becomes formal. And I expect the frontier model developers, including Anthropic and its peers, to quietly accept a new reality in which major releases are preceded by private briefings to Washington. Some of them already do this. It is about to become standard. Now let me walk you through the trade-off matrix. In the base case, growth expectations are essentially unchanged. Liquidity conditions are unchanged. Risk appetite is marginally softer at the sector level, specifically within large capitalization technology names with heavy exposure to enterprise artificial intelligence deployment. Bank equities trade sideways with a slight negative bias as the earnings season unfolds and cyber questions dominate the question and answer segments. Cybersecurity equities outperform modestly, but not dramatically, because this story has been building for some time and positioning is already leaning that way. In the bull case, the meeting is interpreted as proactive rather than defensive. The narrative shifts to the idea that American institutions are coordinating effectively, that the private sector and the public sector are working in tandem, and that the United States is building a governance moat around frontier artificial intelligence that ultimately benefits domestic incumbents. In that world, large capitalization technology holds up, banks recover quickly, and cybersecurity names continue to grind higher. This would require no further escalation, no leaked memos, and a calm earnings season. I put this scenario at roughly a 1 in 3 probability over the next 1 to 4 weeks, which is higher than where I believe the market currently has it. Growth is not the channel through which this matters. Liquidity is not the channel either. The channel is positioning and risk appetite within a crowded consensus trade. That's the part I want listeners to sit with. What should you watch? The first thing to watch is the language on bank earnings calls over the next 2 weeks. Listen specifically for how chief executives describe their artificial intelligence vendor relationships. If they use phrases like rigorous vendor review, independent validation, or ongoing consultation with regulators, that tells you the legal and compliance functions have already taken control of the narrative. That is a signal that the industry is moving from offense to defense on this theme, even if the headline numbers look fine. The second thing to watch is whether any Federal Reserve governor or Treasury official gives a public speech in the next 2 to 3 weeks that uses the phrase systemic artificial intelligence risk or any close variant. The moment that phrase enters, even once, the market should take notice. It would suggest that what happened this week was not a one-off conversation, but the beginning of a framework. The third, and this is more subtle, is to watch the relative performance of the largest American banks against the regional banks over the next 1 to 4 weeks. If the large banks begin to outperform on the view that they have the resources to defend themselves, while smaller institutions do not, that's the market beginning to price a 2-tier outcome. That would be a meaningful signal. On the invalidation side, if the story fades completely within 7 to 10 days, if earnings calls do not feature substantive cyber questions, and if no additional policy language emerges, then the base case I have outlined is wrong, and this really was just a one-time precautionary meeting. In that scenario, you fade any defensive positioning and return to the prior regime. Let me close with a note on framing. It is tempting when a story like this breaks to rush to either dismissal or alarm. The dismissive read is that Washington is catching up to something the private sector already understood. The alarmist read is that a new systemic risk has just been announced. Both readings miss the point. The point is that the relationship between frontier artificial intelligence and the financial system is being formally negotiated in private by the people who set the rules. That negotiation will produce outcomes. Some of those outcomes will be small, some of them will be larger. None of them are priced in with any precision today because the conversation itself is only days old. For portfolio managers, the practical implication is not to reposition violently. It is to recognize that the distribution of outcomes around the artificial intelligence trade and the financials trade has just widened, even if the central estimate has not moved. Wider distributions deserve slightly smaller position sizes, slightly tighter stops, and slightly more attention to the tails. That's how disciplined capital responds to a shift in the policy backdrop. This is market commentary, not financial advice. Markets move on narratives, capital moves on probabilities. If this analysis was useful to you, please subscribe to Global Markets Daily Brief and consider sharing the episode with a colleague who thinks about markets the way we do here. New episodes every trading day. I am Jonathan Simkovitz. Thank you for listening, and I will see you tomorrow.